The world is full of brilliant people who understand complex systems, master difficult concepts, and climb to the top of their industries, only to sabotage themselves when it comes to investing. Why? Because being intellectually gifted doesn't automatically translate into financial wisdom. In fact, intelligence can often become a liability when it isn't tempered by self-awareness, discipline, and humility. You see, the market doesn't reward IQ points. It rewards behavior. And there's a long list of investors, economists, and financial analysts who thought their degrees and models gave them immunity from the natural laws of human emotion. They believed they could outthink the market, and they paid the price for that belief. Take the story of long-term capital management, for instance. Formed in 1994 by some of the brightest minds in finance, including 2 Nobel Prize-winning economists, the hedge fund was supposed to be unstoppable, with a strategy grounded in sophisticated mathematical models. It seemed like a sure bet. At its peak, LTCM controlled over $1 trillion in market exposure. But brilliance without humility is a recipe for disaster. By 1998, just 4 years after its inception, LTCM collapsed in one of the most spectacular financial failures of all time. The very intelligence that made them confident also made them blind to the risks they underestimated. So what went wrong? And more importantly, how can you avoid falling into the same traps? Let's begin with one of the most dangerous pitfalls: overconfidence. Picture this. You're an experienced mountain biker, flying down a trail you've ridden 100 times. The sun is shining. Your legs are strong. The trail feels like an old friend. You hit every curve with precision. You feel invincible. Until, in a split second, something unexpected, a loose rock, a hidden branch, sends you flying. Confidence, once your strength, becomes your downfall. This is exactly what happens in the markets. Investors start out cautiously, then succeed a few times, and begin to believe they're unstoppable. They confuse skill with luck. The better things go, the more risk they take on, and the more blind they become to danger. They stop asking what could go wrong, and start betting like the market owes them something. Charlie Munger once summed it up perfectly. To the man with only a hammer, every problem looks like a nail. Overconfident investors tend to apply the same mental tools to every situation, even when the terrain has changed. They assume the past predicts the future, and that is when trouble begins. Warren Buffett tells a story that drives this lesson home. In May 1901, a dramatic battle unfolded over control of the Northern Pacific Railway. 2 powerful businessmen, Edward Harriman and James J. Hill, each tried to gain majority ownership. Neither knew the other was buying up shares. As it turns out, both parties ended up owning more than 50% of the company's stock. The result? A short squeeze so extreme that Northern Pacific stock price jumped from $170 to $1,000 in a single day. That kind of price spike didn't just crush portfolios. It shattered lives. One small note in the newspaper told of a brewer in Troy, New York, who received a margin call he couldn't cover. He ended his life by diving into a vat of boiling beer. It's a haunting image, and one Buffett has never forgotten. The lesson isn't just about price volatility. It's about the emotional volatility we all carry within us. Markets may seem rational, but they are powered by human hopes and fears. When overconfidence meets leverage, the outcome can be catastrophic. To protect yourself, you need to do what Buffett does: plan for the unexpected and stay grounded. One of his favorite techniques is the circle of competence. Instead of chasing the hottest trends or most exciting stocks, Buffett asks a simple question: do I understand this business well enough to predict its future? If the answer is no, he walks away, no matter how attractive the opportunity appears. This simple practice, knowing what you know and what you don't, can save you from many costly mistakes. But there's more to the story. Overconfidence isn't always loud and proud. Sometimes it disguises itself as certainty, the kind of certainty that feels like rational conviction, but is actually rooted in emotional bias. And this is where even Warren Buffett has slipped. In his 2011 letter to shareholders, Buffett made a confession. He'd invested nearly $2 billion in the bonds of Energy Future Holdings, a decision he would later call a big mistake. Why? because he assumed natural gas prices would continue rising. His analysis, though seemingly thorough, was colored by the optimism of the moment. Prices had been surging for years. Investors, including Buffett, believed the trend would continue. But trends are not truths. Later, Buffett explained the misstep plainly. I totally miscalculated the gain/loss probabilities. In tennis parlance, this was a major unforced error. What caused this lapse in judgment? One word: confirmation bias. Psychologists define confirmation bias as a tendency to interpret new information in a way that supports what we already believe. Buffett puts it this way: what the human being is best at doing is interpreting all new information so that their prior conclusions remain intact. Even the best minds fall into this trap. In Buffett's case, he admitted that the mistake was made without consulting his longtime partner Charlie Munger. That extra perspective, someone to challenge his assumptions, might have made all the difference. This moment of reflection led Buffett to include a simple but powerful statement in his 2013 letter. Next time, I'll call Charlie. It's a reminder that intellectual independence should never become isolation. When we surround ourselves only with people or sources that agree with us, we lose our ability to see clearly. So, what do you do if you don't have a Charlie Munger in your life? That's where tools like the risk assessment checklist come in. This list forces you to slow down, ask uncomfortable questions, and challenge your assumptions before making an investment decision. It serves as a personal devil's advocate, something every investor needs more of. Buffett and Munger's success isn't just about picking the right stocks. It's about avoiding the wrong traps. And one of the most deceptive traps is complexity. Let's dive into that next. But before we continue, if you've ever made an investing mistake that you now recognize in a different light, share it in the comments. Your story might help someone else avoid that same trap. And if you're finding value in this exploration of behavioral pitfalls, make sure you like this video and share it with a friend who might benefit too. Let's go back to the idea of complexity. Most intelligent people crave mental stimulation. They like puzzles, they chase novelty, and they seek out systems they can master. That's part of what makes them smart. But in investing, this same tendency can lead to disastrous decisions. In the kitchen of the market, smart investors are like overzealous chefs. Surrounded by exotic ingredients and top-tier tools, they try to make the most impressive dish possible. But it's often the chef who sticks to a simple, timeless recipe, executed flawlessly, who delivers the best result. Warren Buffett freely admits he fell into this trap early in his investing journey. Between the ages of 11 and 19, he devoured every book, chart, and theory he could find. He explored technical analysis, trend lines, moving averages, you name it. And while he didn't do terribly, he was, in his own words, floundering. The turning point came when he read The Intelligent Investor by Benjamin Graham. It was a revelation, not because it introduced him to a complex new system, but because it stripped away the noise. It taught him that simplicity is strength. Buffett later said, "If I hadn't read that book, I don't know how long I would have gone on looking for head and shoulders formations and 200-day moving averages." I love that kind of stuff, except it was the wrong stuff. Graham's philosophy was grounded in logic, patience, and discipline. It didn't promise excitement. It promised results. And that's what Buffett needed most. But why do so many intelligent people resist simplicity? It's because simplicity often feels beneath them. It lacks the adrenaline rush. It doesn't showcase their brilliance. There's no applause for stepping over a 1-foot hurdle, only for flying over a 7-foot one. But as Buffett famously said, you don't get extra points for jumping over a 7-foot bar if you could have easily walked over a 1-foot one. Simplicity is not the absence of sophistication. It's the distillation of wisdom. And in investing, it's often the difference between winning and losing. Now, let's shift to another subtle yet destructive behavior: emotional projection. This happens when investors assume that their emotions mirror the market's logic. When they feel optimistic, they assume the market will go up. When they feel nervous, they believe the market is about to crash. But the market isn't a mirror. It's a vast, chaotic arena of human behavior, and it doesn't care how you feel. Emotional projection leads to reactive investing, buying when everyone else is euphoric, selling when fear takes over, chasing headlines instead of value. It's the exact opposite of what Buffett does. He once said, "Be fearful when others are greedy, and greedy when others are fearful." This principle is easy to say, but hard to live, especially in the heat of the moment. Let's look at an example. In the dot-com bubble of the late 1990s, countless investors jumped into tech stocks with no earnings, no business model, and often no product. Why? Because everyone else was doing it. The market was euphoric. New millionaires were minted overnight, and the fear of missing out was overwhelming. Then came the crash. Between 2000 and 2002, the Nasdaq lost 78% of its value. Retirement accounts were wiped out. Fortunes disappeared. The same cycle repeated in the housing bubble of 2008, and again with meme stocks and crypto, manias years later. Each time, the pattern was the same. Optimism turned into euphoria. Euphoria became arrogance, and arrogance led to collapse. What's the antidote? Buffett recommends building a rational framework before emotions take over. That includes having a clear investment thesis, knowing your risk tolerance, and sticking to your plan, no matter what the headlines scream. It also means embracing delayed gratification. Smart people often want fast results. They're used to solving problems quickly. But investing isn't a sprint. It's a marathon. The best returns come to those who wait. Consider this. If you had invested $10,000 in the S&P 500 in 1980 and simply left it there, you have more than $1 million today without doing anything fancy, just by sitting still and not reacting. Buffett himself built most of his wealth after the age of 50. Why? Because compound interest is slow at first, but relentless over time. Unfortunately, many investors interrupt that compounding by switching strategies, chasing trends, or trying to time the market. It's like planting a tree and digging up every few months to check the roots. Now, let's talk about another mental trap, narrative fallacy. Humans are storytelling creatures. We love neat explanations, dramatic arcs, and moral clarity. But in the market, stories can be dangerous. They oversimplify reality. They turn complex systems into fairy tales. And they make us overconfident in our predictions. For instance, a company announces a new product. A charismatic CEO gives an inspiring speech. Suddenly, analysts write glowing reports. Investors start to believe a narrative. This company is the future. The stock soars, not because of fundamentals, but because of the story. But stories aren't facts. And when the narrative breaks, reality crashes down. This is why Buffett avoids companies with hype and favors those with consistent earnings, clear business models, and understandable products. He doesn't invest in dreams. He invests in businesses. And that's a crucial distinction. One of the reasons smart people fall for stories is because they're good at creating them. They can justify almost anything with logic, analysis, or data. But analysis built on a flawed premise is like a mansion built on sand. It looks impressive until the ground shifts. This is why Buffett values clarity over cleverness. He looks for simple truths, not sophisticated stories. And he trains himself to separate the signal from the noise. You can do the same. When analyzing an investment, ask yourself, is this based on numbers or on narrative? If the story disappeared, would I still want to own this? Am I being sold a vision or shown a business? The more honest your answers, the safer your decisions. We've covered overconfidence, confirmation bias, complexity, emotional projection, delayed gratification, and narrative fallacy. These are not just academic concepts. They're daily challenges for anyone who wants to grow wealth wisely. And perhaps the most difficult trap of all is ego. Smart people often derive identity from being right. They equate self-worth with performance. But in investing, being wrong is inevitable. No one bats 1,000, and the market doesn't reward pride. It punishes it. Buffett has said, you have to be able to say to yourself, the market is telling me I'm wrong, and I have to change my mind. That's not easy, especially when your reputation, your confidence, and your ego are all tied to your last decision. But humility is the secret weapon of great investors. The ability to admit mistakes, to learn from them, and to adjust without emotional resistance. That's where real power lies. So as we move toward the final part of this journey, ask yourself, what habits are helping you? Which ones are hurting you? And how can you design an investing approach that doesn't just reflect your intelligence, but honors your values, your goals, and your human nature? If this has given you something to reflect on, share it in the comments. Let us know which idea challenged you most. And if you haven't subscribed yet, check to make sure you're following the channel. Many viewers don't realize they're not subscribed. Click that button and turn on notifications so you never miss a new insight. Let's take everything we've explored so far and bring it into one central idea. The goal of investing isn't to prove you're smart. It's to build wealth that lasts. It doesn't matter how intelligent you are, how many books you've read, or how many charts you've memorized. What truly matters is whether you can make sound decisions consistently, protect yourself from your own mind, and stay the course when others lose theirs. Warren Buffett and Charlie Munger are widely considered the greatest investment duo in modern history, not because they chased risk, but because they avoided it. Their success wasn't built on speed. It was built on resilience, discipline, and a relentless commitment to timeless principles. They mastered the mental game of investing, and they did it by focusing on what not to do just as much as what to do. This is a mindset shift. Most people think the best investors are those who make the boldest bets or predict the next big thing. But in reality, the best investors are often the most boring ones. They understand a few companies deeply. They buy them when they're cheap, and they hold them for decades. They don't panic. They don't show off. They don't chase noise. Buffett calls this sitting on your hands, investing. It's not exciting, but it works. This approach forces you to ask, do I want to be impressive, or do I want to be wealthy? Let's return to the metaphor of the mountain biker. Earlier, we talked about the rider speeding through the trail with confidence until something unexpected threw them off balance. But imagine a different rider, one who still loves the ride but respects the risks, one who checks their equipment, rides within their limits, and knows when to slow down. That rider may not look flashy, but they finish the race. That's how you want to invest. You want a system, one that is clear, repeatable, and emotionally neutral. Because if your process depends on being in the right mood, or waiting for inspiration, or having perfect conditions, it won't survive the chaos of real markets. Warren Buffett's strategy has 7 core questions. These are the filters he applies to every investment decision. Is the business simple and understandable? Does it have a consistent operating history? Is it managed by competent, honest people? Does it have favorable long-term prospects? Is the price attractive relative to intrinsic value? Does it generate strong returns on capital? Is it within my circle of competence? Notice what's missing here. No mention of stock charts. No predictions about the economy. No fancy jargon or speculation. Just fundamentals, discipline, and deep understanding. You can use these same questions in your own investing, and you don't need billions of dollars to do it. The principles apply just as well to someone with $500 as they do to someone with $5 million. That's the beauty of timeless strategies. They scale, and perhaps more importantly, they compound. Let's talk about compounding for a moment, because it's often misunderstood. People see it as just a financial function, interest on interest. But in truth, compounding applies to everything. Your knowledge compounds. Your discipline compounds. Your habits compound. Even your emotional intelligence compounds over time. Every time you pause to question a bias, every time you choose patience over impulse, every time you review your mistakes with honesty, you're building internal capital. And over time, that capital becomes more valuable than anything you'll find on a stock ticker. This is why Buffett is still going strong in his 90s. Not because of luck or secret information, but because he invested in himself first. He created a philosophy he could trust, one that worked in bull markets, bear markets, and every environment in between. You can do the same. Create your own checklist. Write down your core beliefs. Build rules that keep you grounded when the world goes crazy. Don't just read what the greats say. Study how they think. Look for patterns of behavior, not just moments of brilliance. And most importantly, remove ego from the equation. You're not in the market to impress anyone. You're in the market to create freedom, security, and opportunity for yourself and for those you care about. Because at the end of the day, the smartest investor isn't the one with the best theory. It's the one who knows who they are, stays calm in storms, and never forgets what really matters. You don't need to outsmart the market. You just need to outlast the people trying to. If this message spoke to you in any way, share it with someone you know who's walking the same path. And tell us in the comments which principle from Buffett or Munger has helped you the most. We'd love to hear your story.